Good morning.
Good morning.
Chair calls the State Board of Finance to order. Everybody in the room except Commissioner McLean, who's online. The first item on the agenda is the review of the March 26, 2025 minutes. Included in your packet that was emailed out. Are there any changes to the draft of the minutes?
Motion to approve.
Motion to approve, second. All those in favor say aye. Aye. And the minutes, March 26, 2025 minutes are approved. Next item on the agenda is to turn to the treasurer for his report. Treasurer.
Thank you. So we have the team here today to report the third quarter results of fiscal year 2025. We had another solid quarter, even when we have uncertain market at this time, but I think the team did a great job navigating through the season that we're in. Regarding foreign investments, we did purchase Israeli bonds in an amount consistent with our historical levels. And this session, we had a couple of things. Act 739 cleans up the existing laws and conforms the law to actual practice. And another one removed the requirement of obtaining 2 investment grade ratings for banks, which will allow more money to remain in the state, because a lot of our banks or financial institutions only have 1 rating. So that law, I think, will help some of our in-state financial institutions. So at this time, I'm going to hand it over to the team, and I believe Stephen Kilgore is up first.
Thank you, Mr. Treasurer Thurston, Chairman Hudson, and board members. I'm Stephen Kilgore, Director of Investment Accounting. So in reviewing some of the highlights for the quarter, I want to begin with the trend in investment revenues. On slide 2, we have results on a month-by-month basis. There in yellow and dark red, we have short-term and long-term investment revenue. So in the far right, the most recent quarter, we've got $26.5 million from medium and long-term bonds, the dark red, and short-term revenue provided $7.3 million to total $32.9 million altogether for the most recent month. And for the quarter, the total was $96.8 million. Then the next slide shows the divisions of income by type of bond. Ledger receipted income, which represents funds available for immediate expenditures, on the far right side. And you can read it, accrual-based income, which is second from the right, shows income as considered earned on an accrual basis. Earnings totaled, again, $96.8 million for accrual income and $102.4 million for receipted income. And within short-term investments, short-term corporate obligations, commercial paper, that is commercial paper, short-term corporate obligations provided the largest component of income, earnings at over $11 million. And within the long-term section, the most significant source has been from federal agency mortgage and asset-backed securities, which provided $51.1 million on a receipted income basis. And that segment totals $50.7 million on an accrual basis, shown by those subcategories within that. We have agency CMOs, agency MBS, and asset-backed securities. Slide 4 then shows the division of assets as measured by their book values in percentage terms, with federal agency-sponsored mortgage-backed and loan-backed securities at close to 56% of the total. That's in the dark red. Government bonds of various kinds, including the Israel bonds, in that total it comes to 19%, short-term investments at 18%, and medium to longer-term corporate bonds at about 7%. Slide 5 shows trends in investment income over recent fiscal years and quarters. Fiscal year 2025 investment income continues the upward trend reported in the prior 2 fiscal years. Net income totals $298.8 million for the 9 months ended March 2025. Net income by quarter, despite a $165 million decline in book value from the start of the fiscal year and lower bond yields in general available on new purchases, showed only minor declines by quarter. Net income was $96.8 million again for the third quarter. Book return on an annualized basis was 3.46% for the January to March quarter. Total return without annualizing was 5.04% as bond market values rose with lower long-term interest rates. And moving to slide 6, we show the mix of the portfolio by duration group. At the top, that's at the top. The illustration is on a market value basis, so it's impacted by bond pricing changes as well as by purchases, maturities, and sales. March allocation percentages in dark red are shown to the right of each December allocation percentage in yellow. So a little bit lower amount in the short term and a little bit higher in medium term. In the charts just below, commercial paper and corporate bond, S&P and Moody's ratings are shown. These are for our corporate holdings within each category. The available ratings show high quality and low credit risk. And the next slide, final slide, shows the trend in bond yields over recent fiscal years. Long-term bonds have risen over the past 3 years, which has allowed maturing bonds to be replaced with higher yielding securities. Median and long-term bond rates have tended to follow the short-term interest rate level, which is set by the Federal Reserve, which is represented by that white line, which leads the other lines in this trend. So Arkansas portfolio returns have moved in line with the bond yield trend overall as bonds mature and are replaced. I would now like to turn it over to investment managers Steve Cooley and Robert Romanek to discuss the portfolio and plans from a strategic perspective.
Thank you, Stephen, Mr. Chairman, board members. As you can see, we've had another steady numbers to report today. The portfolio for Q3 produced the results of return of 346, which is slightly above what we projected, 3.3 to 3.4 for the quarter. The portfolio generated almost $97 million of income for Q3 on an accrual basis. And these results really validate the construction of the portfolio by offering stable income and reduced volatility during this transition of interest rates. The posture of our portfolio is to perform well if rates decline in the future. If you remember at the beginning of the fiscal year, we were anticipating 8, possibly 9 interest rate cuts by the Federal Reserve Bank. We got 4, and then there was a pause, and that pause has allowed us to purchase higher yielding bonds throughout the year. And the theme for this quarter, I would say, is volatility. As many of you have experienced and witnessed the volatility in not just the stocks, but also the bond market. And this volatility gave us good opportunity to take advantage of the dislocations and add quality bonds with relevant value during this period. Looking into Q4, we anticipate more stable rate environment with similar results. The total size of the portfolio remains steady at $11.4 billion. The book value in the long-term portfolio is $9.6 billion. That earned a 326. That's the basis for our returns for the portfolio. The liquidity component of the portfolio returned 4.4%. And our money management trust fund, which is the fund for the state and local governments to participate in, returned 453. So that's a great return as well. Enclosed in your packet is our 12-month forward projected principal cash flows from the portfolio at the end of Q3. And the portfolio returned along with the earnings projection for the next 12 months forward is close to $1.3 billion. This additional cash flow will provide our investment team with ample flexibility to address any unforeseen liabilities that may arise throughout the year. And so with that, I'll open it up to any questions about it.
Steve, just a question about relative concentration of the portfolio by duration, going back to the slide that Stephen had as well, on slide 6 or 7. Just any general comments about what we can potentially do to move some of that more out longer term? We have a pretty high concentration at less than a month, I think about 20% of the portfolio. What can we do as, I guess, as an executive branch to give you the data that you need, maybe push some of that out in terms of you?
Well, from a liquidity standpoint, I mean, I think our team does a good job, and Damon Dorch that handles the liquidity, he interacts with the agencies to try to understand what some of our liabilities coming up are. And in terms of having hard data, real time, something you can model them and model this cash flow a little more accurately with real data, we don't have that ability to do that. So to answer that question, if you're going to manage that cash flow better, I think having more real-time data available, and so you could peer into and know what's going on, so you can make those projections and be a little more precise on that liquidity component.
It's an area of focus that I think we've got at DFNA right now. I mean, our fund balances are just so staggeringly high. And even with yields coming down, we still have opportunity to make a fair amount of money for the state. But I think we've got to give y'all the information that you need to have to park the money at the right duration. So I think just for the board, I would say that's something that Mr. Babbitt and I, our state controller, are having ongoing conversations about, because I do think we can maximize earnings for the state by pushing some of that out, but further out in the yield curve.
Right.
Okay. Thank you.
With that, I'll turn it over to Robert Manick, and he'll give you the macro plus the Q4 benchmark.
Thanks, Steve. Good morning, Chairman Hudson, Treasurer Thurston, and members of the board. With your consent, I will be setting the new target rate of book return for the fourth quarter of fiscal year 25. At their scheduled meeting on May 7th, Federal Reserve Committee members voted to keep monetary policy on hold. This decision represented the third consecutive pause of the easing cycle and left the Fed funds target range at 4.25% to 4.5%. Fed board members have made it clear they are reluctant to preemptively cut rates given so many unknowns about the future of tariff policy and how the economy will respond. Central to this decision is the view that the evolving policies of the new administration have triggered heightened volatility and uncertainty, with a recipe for stagflation becoming a growing concern. The release of the Federal Reserve's meeting minutes noted the economy continued to expand at a solid pace, unemployment has stabilized around a low overall level, and inflation remains somewhat elevated. This appears to indicate that the median Fed view for now has moved toward fewer interest rate cuts rather than more. Currently, however, the forward interest rate curve forecasts 325 basis point rate cuts for the remainder of 2025. From a portfolio perspective, this dichotomy between Fed and market sentiment and the resulting unpredictability highlights the importance of maintaining diversification and emphasizes a dynamic and opportunistic approach to capitalize on market swings. Overall, Fed officials will need to balance the possibility of deteriorating employment against the risk of higher inflation. This will likely be addressed using a meeting-by-meeting process and in a protracted fashion, as the Fed does not have the luxury to resume rate cuts with inflation still above their 2% target and facing upside risks in a stagflationary climate. Given this outlook, we are proposing to increase the target rate of book return for the April through June period from a range of 3.3 to 3.4% to a new range of 3.35 to 3.45%. Thank you, Mr. Chairman.
Any questions for the treasurer's staff? All right, at this time, I'll entertain a motion to set the target rate of book return for April through June to a range of 3.30 to 3.340% to the new range of 3.35 to 3.345%. Is there a motion? Commissioner, give a second. Second. All those in favor say aye. Aye. All those opposed? Aye. Commissioner McManus, the new target book rate of return is established. Now we'll turn to the quarterly motions. As chairman of the State Board of Finance, I make a motion to the board that no funds are available for deposit in the State Board of Finance certificate deposit program. Is there a second to my motion? Second by Secretary Biskin. All those in favor say aye. Aye. All those opposed, no. Ayes have it. Further, as chairman of the State Board of Finance, I make a motion to the board to direct the treasurer of state to purchase warrants for the succeeding quarter, April 1st, 2025 through June 30, 2025, pursuant to Act 1088 of 2013, and to keep reasonable amounts in demand deposit accounts and money markets during the next quarter for the transaction of day-to-day activities of the state. Is there a second to my motion?
Second.
Second by Commissioner Marshall. All those in favor say aye. Aye. All those opposed, no. Motion carries. Moving to our next item on the agenda, really more of a discussion item than a decision for the board today. We just wanted to give the board a heads up, if you will, that we're gaining in responsibilities in terms of the new fiscal year. Act 560 of the 95th General Assembly 2025 adopted a captive insurance structure for the state of Arkansas. For those of you, particularly in the private sector, know that property insurance has been in a state of volatility for some time. And we've struggled as a state to, despite the best efforts, I think, of the insurance department, just the market conditions being what they are, to get favorable rates for the state and really more importantly for our local school districts. We've seen some really high premiums in the recent years. So the thinking is that we could take, that book of business and move it into a captive insurer, which is a insurance company wholly owned by the state that would let the retained liability be managed by the state, kind of like a self-insured medical plan, which we run through EBD. And so the legislature, working in cooperation with the governor, administration, came up with the language that's in Act 560. It will be run, the captive day-to-day through TSS, just like EBD is run through TSS. Our responsibilities will be very similar as to what they are with EBD. One will approve the formation of the captive when the treasurer's office and TSS are at that place to present that to us. We'll set the investment policy for the reserves for the captive. And then we'll review from time to time the funding for the captive, from what the rates are based on recommendations from TSS, determine what the adequate level of reserves are, review the actuarial reports. Essentially, we will be the board of directors, for the insurance company. So those will be our responsibilities going into the next year. We have sent to you a copy of Act 560. So I would encourage you to take some time to review that. And in particular, I would say review Section 12 of the Act, which begins on page 18, which lays out the responsibilities for the Board of Finance. And then also review page 30 and 31, which also includes responsibilities for the Board of Finance. I would also anticipate that once the treasurer's staff and TSS have done all the preliminary work, including drafting a proposed investment policy, we'll need to schedule a special meeting of the Board of Finance sometime in June to approve all those measures and get us ready to roll into the next fiscal year. Mr. Wallace is here. He'll have responsibility for it. And also Jessica Patterson, who is the general counsel for TSS and head of procurement, and generally just a very, very smart person that we love to have in meetings. So I don't know if y'all want to come to the table and field any questions from the board members. Question is there any extra pay? No, but I'm hoping we'll kind of get some of those nice little calendars like all insurance agents have. And we'll be able to. Any questions about the captain?
I was saying we got really good historical data to make this decision as far as what we're able to model what would have happened the last couple of years.
Yeah, we have, the legislature has taken the lead on this. They hired their own advisor, actuary here at night. They did some modeling using the historical and also trending forward. I think they're expecting that there might be free cash flow generated off this, an additional couple $1 million a year. I think that all will depend on what the actual experience is. They were assuming about 3% rate of return as well. I think we're doing a little bit better than that in the treasurer's investments, so maybe we'll get a little bit more than that. My own view is that at least for year one, so for FY26, caution is in order until we get a good baseline established. So we'll be very conservative, I think, on the investments. We will have capped liability on this. I think the proposed retention is around $50 million per year. So once you hit that, it's all on the reinsurers at that point. We have Stevens is the kind of captive advisor for us on this, their insurance division. They've been discussing with the reinsurance market, the Lloyd's market in London about getting the most favorable rates. So to the extent that we get good rates for the reinsurance, experience comes in at a favorable place. For us, experience means minimizing the number of hail storms that we've got and wind damage. Those are our big losses that we have in state properties. And we could have a good year. But knowing that our liability is capped. Good question. Other questions? Then we have Mitchell Williams advising on the actual formation of the captive. So we'll prepare the form policies for that as well.
And the rules.
And the rules. For any school district, local school district that receives state aid through our facilities assistance program, construction assistance, in order to receive that, you've got to be a part of the captive program. That's a way to ensure that all the facilities are being adequately maintained and that repairs are being made on a timely basis. So that's a kind of a measure we have in place to ensure that we pull down some of the costs. We're not paying as a casualty dollars that really should have been spent. That's a little bit of a struggle we got right now. Also, state agencies were required to participate in all higher ed institutions as well. So it'll be a fairly large insurance program. Any other questions? Okay, like I said, no motion on this, no decision today, just kind of understand that sometime in the next 2 or 3 weeks, we'll be reaching out and schedule a special meeting to go through all the preliminary approvals that we need to get the thing going by July 1st.
Here, I do a question. Curious, do we know how many other states have the structure?
Tennessee does. I know, I think there are a couple of Texas, I believe is moving forward.
20s, somewhere in the low 20s.
Yeah, okay, so there's quite a few.
So we would have resources even if that were to
Yes,
be necessary.
yeah, we've actually had a few conference calls already, sister states about what their experiences. Some of those are very small, some of them are very large. I think we'll be one of the few that actually has local school districts, involved in the program. Question. Okay, well, if there are other questions, just stay tuned. More to come on that. And again, you should have the full act in your email inbox, so we'll get back to that. And so with that, Mr. Watson, go ahead and turn it over to you. Thank you, Jessica.
Thank you, Mr. Chair. We will start with the April 2025 EBD formulary. You will see a lot of these are just re-tiering some of the not covered. One I do want to point out is when you're looking at Paxlovid, we're just updating the quantity limits from 20 to 30 tabs per fill without a time limitation to 1 course per 90 days. There was only one instance out of 634 in the past 6 months where they took they went back and got a refill on the Paxlovid. We've just found that that's not really the best way to deal with a reinfection within that time frame. And it's just not really clinically justifiable. So we're aligning our quantity limits to best match up with CDC recommendations and clinical recommendations on that. That is probably the only one. There were some new to markets down at the bottom. The Althorlab suspension, oregano tablets, Ypropad, those were just new to markets that we're going to continue to not cover until we have some additional clinical data for efficacy. You'll see some additional on primary biliary chylomicronis. Again, same situation. There's some new to markets that we're just not going to cover at this point. Atopic dermatitis, that was just a clinical look at some of the new ones that are out there. We're going to keep those. We are going to move from not covered to covered, but keep them on the specialty tier. So there are some step therapies, prior authorizations that go with them. With that, be glad to answer any questions on May's EBD formulary.
Any questions? Seeing none, I'll entertain a motion to approve the recommendations. Motion's made and second to approve the recommendations for formulary. All those in favor say aye. Aye. Those opposed, no.
Okay, moving on to the May EBD formulary. You'll see here, similar, there's some new to not covered that we're kind of re-tiering and adding on. The second one, the Irenzoic suspension, we're just adding a prior authorization so that members 9 years and older, the thought is that you prevent people that can't take a pill. Children, obviously, 9 and under still need that oral suspension to be able to swallow as opposed to a pill. The Triumpha, that's a new packet that we're bringing on, updating some of the packaging around the distribution of that drug. We are removing the Betadine powder. This really, there is a generic that is at a lower net cost at the time that we're going to prefer on our formulary. The one member that is taking this, we are going to allow them the lifetime guarantee, but we're putting this in place to prevent any new starts or go through the appeal process to get it just a little different, higher level scrutiny on that one. On the multivitamin maintenance, that was just a whole class reevaluation, and we're moving those to not covered because obviously they can be over the counter and can be taken without utilizing a pharmacy benefit. With that, be glad to answer any of the May EBD formulary questions.
Hearing no questions, is there a motion to approve the May 2025 EBD formulary recommendations?
McLean moves.
We'll take yours as a second, Secretary Biscuits. Motion's been made and seconded. All those in favor say aye. Aye. All those opposed, no. Motion carries.
And now we'll move to the May 2025 medical drug recommendations. Always my disclaimer with these, just to make sure everybody's clear on what we're doing here. These are drugs that are administered in a clinical setting and roll through our medical benefits. EBRX manages the prior authorization and the setup of the formulary on this side of things in coordination with Health Advantage. Really, the only one that I would probably highlight on this is EYLEA. This we're adding back. EYLEA is the name brand. Recently, we had moved to bring on the biosimilar. With this one, we're just running into some providers that are having access issues and getting it. So we're just bringing this one back on for a year to let that rollout of the biosimilar happen. and make sure that we're not disrupting any care. Everything, you'll see the ones that are excluded, again, those will not be added. If it's covered with a PA, that's the prior authorization process that EBRX will set up. You'll see 2 of those. And then with ILEA, that just runs through the normal benefits setup that Health Advantage has. Be glad to answer any questions on that.
Hearing no questions, is there a motion to approve the May 2025 medical drug recommendations?
So moved.
Motions are second?
Second.
Second. All those in favor say aye. Aye.
Aye.
Those opposed, no. Motion carries.
Okay, you have one EVD contract this time. This is it's an interagency agreement with the University of Arkansas Medical Sciences. It's a professional service contract. This is the EBRX agreement. This is just a 1-year amendment. We're adding 1.68 million to the contract. You'll see all the numbers and funding on the SRB one that you have before us. There was one additional service that was added this year. It's the third-party reviewer. So the way that we have kind of the review appeal process set up is EBRX and Navis is a front line. They get the first one. Secondary comes to me for review. And if there's still a disagreement between my decision, then they can go to a third party. We outsource those. So EBRX manages that outsourcing and just passes those costs on 100% to us. There's no upcharge or anything like that. What they get charged, they pass on to us. So we're just formalizing that in this agreement, and we added just a little bit of money just to kind of have a cushion in case that did come up. Outside of that, everything else remained as is with their agreement.
How many more renewals after this one?
So Jessica can help me on this one. I think it follows a little bit differently because it's an interagency. I don't necessarily know that there's the 7-year cap on that. Okay.
Any questions for the contract, EBRX? Hearing none, is there a motion to approve?
Make a motion to approve.
Motions are second and second. All those in favor say aye. Aye. All those opposed, no. Motion carries. Contract is approved.
The last item, and it's just for informational purposes, you do have our latest financial report from Milliman included in your packet. Feel free, I would be glad to answer anybody's questions offline or anything like that that you might have on that, but we want to make sure you have that included in your packet for reference.
Any questions? Any other business to come before the Board of Finance? Hearing none, we stand adjourned. Thank you for your attendance today.